Imagine owning a home worth over $500,000 and being completely stuck. You can't move, you can't sell, and every single month you're bleeding money you don't have. This isn't a nightmare. This is real life for hundreds of thousands of California homeowners right now in 2026. See, most people think if you own a home, you've made it. You're free. You can sell whenever you want and walk away rich. But nobody told them about the insurance companies abandoning entire zip codes. Nobody warned them about interest rates that turned their dream into a financial prison. Nobody mentioned that selling their home could mean losing money after fees, taxes, and market crashes in their area. Today, I'm going to expose the 10 California cities where homeowners are completely trapped and cannot sell, even if they desperately want to. Whether you own in one of these cities, plan to buy, or are just trying to understand what's happening to the California housing market in 2026, you need to watch this entire video. Let's get into it. Number 1, San Francisco. San Francisco is supposed to be the crown jewel of American real estate, the city where tech money flowed like water, where a one-bedroom condo could make you a millionaire. But in 2026, San Francisco homeowners are discovering a brutal truth. The Golden City has become a golden cage. Here's what's happening. Home values in San Francisco have dropped significantly from their peak. Some neighborhoods have seen 20 to 30% declines from the highs of 2021 and 2022. And because so many buyers used maximum leverage, putting down the minimum and borrowing the maximum, they are now underwater or barely above water on their mortgages. Selling means writing a check at closing instead of receiving one, but that's only part of the trap. The real killer is the property tax situation. Under California's Proposition 13, longtime San Francisco homeowners pay property taxes based on what they paid for their homes. Sometimes decades ago, a homeowner who bought in 1998 might pay just $4,000 a year in property taxes. If they sell and buy somewhere else in California, they could face property tax bills of $20,000 or $30,000 per year. That is a financial cliff very few people are willing to jump off. Then there's the office vacancy crisis. With remote work permanently reshaping corporate America, downtown San Francisco has vacancy rates that rival ghost towns. When the commercial core of a city dies, it drags residential values down with it. Buyers see empty streets, closed restaurants, and rising crime stats, and they walk away. Insurance is another catastrophe. Major carriers have pulled out of San Francisco and surrounding Bay Area counties entirely. Homeowners who need to sell are discovering that their buyers can't even get homeowners insurance through standard channels, which means many lenders won't approve the mortgage. No insurance, no loan. No loan, no sale. San Francisco homeowners who bought between 2018 and 2022 are the most trapped. They paid top dollar, they're locked into high mortgage rates from refinances, and they're watching their equity evaporate. The dream became a debt sentence. Number 2, Los Angeles. Los Angeles, the city of dreams, of Hollywood glamour, of endless sunshine and celebrity neighbors. And in 2026, the city of homeowners who cannot get out, no matter how hard they try. The numbers in Los Angeles tell a devastating story. Inventory has spiked dramatically as sellers flood the market, but buyers have disappeared. Mortgage rates remain high enough that the monthly payment on a median-priced LA home is completely unaffordable for the vast majority of households in Southern California. A $900,000 home with 20% down and a 7% mortgage rate means a monthly payment north of $4,700 before taxes and insurance. That's more than many Los Angeles families make in an entire month. But here's the trap that doesn't make headlines. The 2025 wildfires that devastated communities across the greater Los Angeles area didn't just destroy homes. They destroyed the insurance ecosystem for the entire region. Insurance companies had already been fleeing California for years. After the massive wildfire losses, the exodus accelerated. Homeowners in fire-adjacent zones, which is most of LE, now face insurance premiums of $10,000, $15,000, even $20,000 per year if they can find coverage at all. When you're paying that on top of a mortgage, you're trapped whether you like it or not. Then there's the equity illusion. A lot of Los Angeles homeowners think they have equity because their Zillow estimate is still high, but the gap between list price and actual sale price is widening every month in 2026. Sellers are dropping prices 10, 15, even 20% below, asking just to find a buyer willing to pull the trigger. When you factor in realtor commissions, closing costs, capital gains taxes, and the price reductions needed to sell, many homeowners are realizing their equity is smaller or completely gone. Los Angeles is a city where the cost of staying is crushing and the cost of leaving is equally brutal. That is the definition of a trap. Number 3, Sacramento. Sacramento had its moment. When San Francisco and Los Angeles became unaffordable even for tech workers, Sacramento was the promised land. Affordable homes, decent schools, state government jobs, and just close enough to the Bay Area if you ever wanted to drive back. Between 2020 and 2022, Sacramento home prices surged over 40% as remote workers flooded in with big city salaries and small town housing budgets. And now, in 2026, those buyers are trapped. The problem with boomtowns is simple. What goes up fast comes down hard. Sacramento prices have corrected significantly from the pandemic highs. Many of the buyers who rushed in during 2021 and 2022, paying $500,000 and $600,000 for homes that were worth $350,000 in 2019, are now sitting on zero equity or negative equity. They overpaid, they know it, and there's no way out that doesn't cost them tens of thousands of dollars. Sacramento also suffers from the return to office problem. Many remote workers who relocated here during the pandemic are now facing mandates from their employers to come back to the Bay Area or Silicon Valley. They need to move, but they can't afford to sell. So instead, they're doing 3-hour round-trip commutes several days a week. Financially trapped in a city, they moved to escape the commute. The Sacramento rental market has also softened dramatically, which means homeowners hoping to rent out their properties and cut their losses can't get rents high enough to cover the mortgage. Negative cash flow every month is just a slower form of the same trap, and Sacramento's job market outside of government work is thin. When the pandemic remote work boom ended, the economic engine behind the housing surge went with it. Homeowners are stuck holding assets in a market that no longer has the same demand drivers that pushed prices up in the first place. Number 4, Oakland. Oakland is a city that has been struggling for years, but 2026 has brought a new level of crisis for homeowners who are desperately trying to sell and move on. The city that sits across the bay from San Francisco, that was supposed to be the affordable alternative, has become a market where homes sit on the market for months with little to no serious interest. The crime situation in Oakland is a major driver of the trap. Oakland's crime statistics have been among the worst in California for years, and high-profile incidents continue to make national news. Businesses have been fleeing the downtown area. A major retailer exodus left entire shopping corridors empty. When buyers do their research before purchasing a home, and they always do, Oakland's crime reputation sends them in a different direction. Lower demand means sellers have to drop prices. Dropping prices means equity disappears. And without equity, there's no financial way to sell and move on. The insurance crisis hits Oakland particularly hard. Older housing stock, proximity to wildfire-prone areas in the hills, and high claims rates from theft and property crime have made insurers extremely reluctant to write new policies in Oakland. When a buyer falls in love with an Oakland home and then can't find insurance, the deal collapses. Sellers are watching offers disintegrate at the finish line over insurance issues. Then there's the Proposition 13 golden handcuffs that lock in Oakland homeowners who bought even 10 or 15 years ago. Their current property tax bill is manageable. Selling and buying elsewhere in today's market, even a cheaper city in another state, comes with a full reset of tax burden that many cannot afford. Oakland homeowners are caught between a market that buyers don't trust, costs that keep rising, and an equity position too fragile to absorb the losses of a real sale. That is a trap with no obvious exit. Number 5, Stockton. If you know your California real estate history, Stockton's name should send a chill down your spine. This was the city that became a national symbol of the 2008 housing crash, the first major American city to file for municipal bankruptcy. And while Stockton clawed its way back through the 2010s and into the pandemic boom years, 2026 is revealing an uncomfortable pattern repeating itself. Stockton has one of the highest concentrations of homeowners with minimal equity in the entire state of California. During the pandemic frenzy, many buyers, often first-time buyers stretching every dollar they had, jumped into the Stockton market because it was one of the few places in California they could actually afford. They put down 3 or 5%, got aggressive purchase prices driven up by bidding wars, and felt like they had finally won. 2 to 3 years later, with values softened and costs exploded, those thin equity positions are gone. Mortgage, property taxes, insurance, and maintenance costs are eating these households alive. But selling means owing money at closing, not collecting it. Stockton's economy is heavily tied to logistics, warehousing, and agriculture. These are sectors that don't provide the kind of wage growth that keeps pace with housing costs. The median household income in Stockton simply does not support the home prices that the pandemic era produced. That fundamental mismatch is now correcting, and homeowners who bought at the top are absorbing the pain. Foreclosure rates in the Central Valley, including Stockton, have been creeping back up. This is the canary in the coal mine. Homeowners who are trapped between a mortgage they can't afford and a sale price that won't cover what they owe are eventually going to face a very hard choice. And for many in Stockton, that choice is getting closer every single month. Number 6, Fresno. Fresno sits in the heart of the San Joaquin Valley, surrounded by some of the most productive farmland in the world. It's also a city where a huge percentage of homeowners bought at the wrong time, at the wrong price, and are now completely stuck with nowhere to go. The Fresno housing market was swept up in the same pandemic fever that affected every California city. Buyers from coastal cities, escaping the astronomical prices of the Bay Area and LA, discovered Fresno and its seemingly affordable homes. Demand surged. Prices surged. A market that was reasonably priced for local incomes suddenly became priced for out-of-towners with remote work salaries. Then the remote work wave receded, and Fresno was left with home prices that make no sense relative to local wages. The median household income in Fresno is one of the lower figures for a city of its size in California. The mortgage payment on a median-priced Fresno home in 2026 consumes an unsustainable portion of the average Fresno household's income. Our buyers who depend on local employment cannot qualify for the loans needed to purchase at these prices. Without a healthy pool of local buyers, sellers are staring at a shrinking market. Homes sit. Price reductions happen, and sellers who bought at the 2021 or 2022 peak watch their equity drain away with every reduction. By the time the price is low enough to attract a buyer, there's nothing left after paying off the mortgage and covering selling costs. Fresno also faces the challenge of being less desirable to out-of-state investors and remote workers compared to coastal California cities. There's no beach, no major tech hub, no glamour factor that makes buyers choose Fresno over, say, Phoenix or Las Vegas when they're shopping from afar. Local demand is insufficient. Outside demand is minimal. That combination leaves sellers waiting and waiting and waiting. Number 7, San Bernardino, the Inland Empire, San Bernardino, Riverside, and the surrounding communities was sold to California home buyers as the solution to coastal unaffordability. Drive a little further, pay a lot less, and get the California dream without the California price tag. For a while it worked, then 2026 arrived. San Bernardino specifically is a city where the homeowner trap has become a genuine crisis. Property values that skyrocketed during the logistics and warehousing boom, driven by Amazon, Walmart, and other e-commerce giants building massive distribution centers, have plateaued and in some areas declined. The workers who powered that boom are often renters, not buyers. The homeowners in San Bernardino are largely people who bought during the pandemic surge and are now confronting the reality of what they paid versus what their homes are worth. Heat is a factor that doesn't get enough attention. San Bernardino summers regularly hit 110 degrees and above. As climate change pushes temperatures higher, buyers from outside the region are increasingly reluctant to commit to a place where half the year is genuinely dangerous to be outside. Insurance costs in fire-adjacent Inland Empire communities have exploded. Utility bills for air conditioning have become a significant monthly burden that buyers factor into affordability calculations and often walk away. The commute reality is also devastating San Bernardino's desirability. Pre-pandemic, people made the sacrifice of long drives to LA or Orange County in exchange for affordable housing. Post-pandemic, with the return to office mandates hitting hard, those commutes are coming back. But the buyers who would have absorbed that trade-off have largely either already bought or decided it's not worth it. The demand that fueled the boom has moved on. San Bernardino homeowners who need to sell are finding a market with fewer qualified buyers, rising days on market, and prices that have retreated from peak levels just enough to wipe out down payments and early equity gains. Number 8. Riverside. Riverside is a city that perfectly illustrates one of the most powerful homeowner traps of 2026, the interest rate lock-in effect. And it works in two devastating directions at once. On one side, you have homeowners who refinanced during 2020 and 2021 when rates dropped to historic lows. These homeowners have 2.5%, 3.5% mortgage rates. Their monthly payments are manageable. Moving means giving up that rate and taking on a new mortgage at 6.5 to 7.5%. On the same priced home, that can mean an extra $1,500 to $2,000 per month. For most families, that is an absolutely impossible financial step backward. So they stay. Even if they desperately need more space, want to move closer to family, or their life circumstances have changed completely, they stay. Because selling means financial suicide. On the other side, buyers who would purchase Riverside homes in 2026 are facing those same high rates. The monthly payment on a Riverside home is crushing at current rates. Buyers are sitting on the sidelines waiting for rates to drop, which means the pool of active buyers is much smaller than it was during the pandemic boom. Less buyer demand means sellers can't get the prices they need to make financial sense. The result is a frozen market. Sellers won't sell because moving costs too much. Buyers won't buy because rates make it too expensive. And in the middle are homeowners who have no choice. A job transfer, a divorce, a death in the family, a medical crisis, who are being forced to sell into a market that is working against them in every possible way. Riverside home prices have softened. Equity is thinner than it looks on paper, and the cost of executing a successful sale is eating up what's left. This is a city where the housing market has essentially seized up. Number 9, Modesto. Modesto is a Central Valley city that most people outside of California have never heard of. But if you want to understand exactly how the California housing trap works for working-class homeowners, Modesto is the textbook case. During the pandemic, Modesto became a destination for buyers priced out of the Bay Area and Sacramento. Home prices that were in the low 300,000s in 2019 shot up to $450,000, $500,000 and beyond by 2022. Local workers, teachers, nurses, warehouse employees, small business owners were suddenly living in homes valued at prices that would have seemed absurd just 2 or 3 years earlier. It felt like wealth. It felt like security. It wasn't. It was a bubble built on pandemic-era demand that has since deflated. Modesto's local economy cannot sustain those price levels. When Bay Area remote workers returned to offices or moved to entirely different states, the external demand that inflated Modesto's market vanished. What remained was a local buyer pool with local incomes trying to purchase homes priced for Silicon Valley salaries. The math never worked, and now the market is slowly, painfully correcting. Homeowners who bought at or near the peak in Modesto are watching equity evaporate. Many are in situations where selling covers the mortgage but doesn't cover the costs of the sale itself. Agent commissions, closing costs, transfer taxes, and preparing the home for market. They would have to bring cash to the closing table to get out. Cash they don't have. Renting out the property isn't a reliable escape valve either. Rental rates in Modesto are not high enough to cover a 2021 or 2022 purchase price with today's tax and insurance costs. Negative cash flow just extends the bleeding. Modesto homeowners are stuck watching the clock and hoping the market recovers before their situation forces a costly exit. Number 10, Bakersfield. Bakersfield closes our list, and it might be the most surprising entry because Bakersfield was once considered one of the most affordable cities in California. It was the place where you could actually own a home, raise a family, and not be buried in debt. But 2026 has turned even Bakersfield into a homeowner trap, and the reasons run deep. Bakersfield's economy has historically been anchored in oil production and agriculture. The oil industry in California has been contracting for years as environmental regulations tighten, and California accelerates its transition away from fossil fuels. Jobs that used to pay extremely well and provided the economic foundation for Bakersfield's housing market have been disappearing steadily. The economic engine that gave Bakersfield its housing demand is slowly shutting down. During the pandemic, Bakersfield still got caught up in the statewide housing fever. Prices rose sharply. Buyers paid prices that were reasonable only if you assumed continued strong local employment and income growth. Neither of those assumptions has held up. With the oil sector shrinking and agricultural wages stagnant, the economic backbone of the city is weaker than it was when those purchase prices were agreed upon. Now, homeowners who bought between 2020 and 2022 are sitting in a market where prices have come down, and the fundamental economic story supports further weakness, not recovery. Insurance costs in Kern County, driven by wildfire risk and heat events, have added another layer of cost that squeezes both owners and potential buyers. The final trap for Bakersfield homeowners is geographic. This city is not close enough to major metropolitan areas to benefit from spillover demand. It doesn't have the coastal appeal that draws remote workers, and its economic story is one that sophisticated buyers can read clearly and run from. Bakersfield homeowners who need to sell are finding a thin buyer pool, a weakening economic narrative, and prices that have eroded enough to eliminate the equity cushion that would make selling painless. This is the California housing trap in 2026. 10 cities, hundreds of thousands of homeowners, and a market that is not going to bail them out anytime soon. If you found this video valuable, smash that like button, subscribe for more real estate truth bombs, and drop a comment below. Are you trapped in one of these cities, or do you know someone who is? Let's talk about it. So there you have it. 10 California cities, 10 different stories, one devastating pattern. Whether it's insurance companies abandoning entire zip codes, pandemic prices that never made sense, interest rates locking people in place, or local economies that can no longer support what homeowners paid, the trap is real, and it's affecting real families right now in 2026. Here's the hard truth. The California housing market is not going to rescue these homeowners overnight. Recovery takes years. And for people who need to move today because of a job, a family situation, a financial crisis, waiting is not an option. If you're one of these homeowners or you know someone who is, share this video. Knowledge is the first step out of any trap. And if you want to know the specific strategies that some homeowners are using to escape, subscribe right now because that video is coming next. I'll see you there.